Next, students, let us look at capital adequacy. What is capital adequacy? What are we talking about? There is something called a capital adequacy ratio, and that is a measure which is used mostly by banks. It measures how banks can protect their depositors and shareholders, right? How banks, what is a bank's business made of? It collects money from a lot of depositors, and this money is again lent to several other institutions or individuals, right? This loan that the bank gives, that is the asset of the bank. Correct? Now, a bank should select its assets in such a way that the shareholders and the depositors' interests are protected. Should select in such a way that the shareholders and depositors' interests are protected. The Basel Committee. Now, you understand the importance of banks in a financial system, students, right? If banks were to collapse, it is a threat to the entire economy of the country, entire financial system of the country. So, there was a Basel Committee on Banking Supervision, an international body consisting of central bankers from different countries. They came together, and after a lot of deliberation, they formulated certain norms. It was called the Basel Accord of 1988. Since 1988, there have been a few updations, a few revisions, and we have now what is called the Basel III. These international standards, the Basel III, several standards are there. One of them talks about a capital adequacy ratio, which is often referred to as the CAR, right? What is the measure for this? The capital adequacy ratio is supposed to be Tier 1 plus Tier 2 capital, Tier 1 capital plus Tier 2 capital divided by the risk-weighted assets. Tier 1 capital, Tier 2 capital divided by the risk-weighted assets. So, the capital divided by the assets is supposed to be the capital adequacy ratio. This ratio, higher it is, the better. The minimum is supposed to be 8 as per the Basel III norms. Now, let us just look at what is Tier 1 capital. Tier 1 capital is the bank's core capital consisting of common stock, right? So, the equity shareholders, whatever they have brought in, the retained earnings, and perpetual preferred stock, that's the preferred stock, which is non-redeemable and non-cumulative. Okay, preference shares, non-redeemable, non-cumulative. That is Tier 1 capital. Tier 2 capital is secondary capital if you have revaluation reserves, right? They have not come in the form of cash. Undisclosed reserves, general provisions, hybrid instruments, and subordinated term debt. That is Tier 2 capital. Tier 1, Tier 2 capital. What are risk-weighted assets? They are the assets, but only the risky portion of the assets is taken. Risk-weighted assets. How do you know what is a risky portion of the assets? All the assets, the loans, they are given certain weightages, and that is considered risk-weighted assets. So the different assets held by banks have different risk profiles. The range is between 0 to 100, where loans to governments are given 0% weighting and loans to individuals are weighted at 100%. So what do you mean? So if there has been a loan of 500,000 to the government, or there are treasury securities, money has been put into treasury securities, that is not supposed to be risky at all. It has a 0% weightage. That means it will not be included at all in the risk-weighted assets, thus resulting in an improved capital adequacy ratio. Yes or no, students? Followed? A bank has 6 million Tier 1 capital and 4 million Tier 2 capital. Its assets are 10 million, 30 million and 15 million to the different companies. Risk of 20%, 50% and 60%. What is the capital adequacy ratio? Come on, compute, students. Tier 1 capital plus Tier 2 capital divided by the risk-weighted assets. You know the Tier 1, you know the Tier 2 capital, right? What is risk-weighted? 20% into 10 plus 50% into 30 plus 60% into 50. 21.28% is the correct answer. Is it correct? Risk weighted is 20% of 10, 50% of 30 and 60% of 50. I hope it's 47 is correct. Correct? Yeah? Okay. And 6 plus 4 divided by 47, 21.28, expressed as a percentage into 100, 21.28%. Yeah? Now, under Basel III, the minimum capital adequacy ratio that banks must maintain is 8%. That's the absolute minimum. And the tier 1 capital to the total risk weighted exposures should not be less than 4%. Applying minimum capital adequacy ratio serves to protect depositors and promote stability and efficiency of the financial system. So the CAR, that is one of the ways in which capital adequacy of the banks is assured. Of course, capital adequacy may consist of how well it manages the solvency, that's long-term liquidity. Liquidity is the short-term. You know what is its capacity to meet the short-term obligations? Capacity to maintain long-term is the solvency. Reserves, whether they have sufficient amount of reserves so that in case of emergency there is always money to pay the depositors, and sufficient capital is whether or not the bank has sufficient capital to properly protect its depositors. There should be enough capital for the depositors' interest has to be protected. Quiz students, ready? Test our understanding so far. What have we discussed actually? We've discussed what? The risk, right? What is risk? The types of risk and capital adequacy ratio. Should be simple. Come on. Which of these statements is false? Risk is a function of volatility. B. Risk is a function of time. C. Risk and uncertainty mean one and the same. And D. Uncertainty represents an opportunity. Risk is a function of volatility. It is a function of time. Uncertainty may represent an opportunity. Risk and uncertainty are not one and the same. Risk and uncertainty are not. So the correct answer is C, because this is a false statement. What is risk? A. Negative consequence that could occur. B. Negative consequence that will occur. C. Negative consequence that must occur. And D. Negative consequence that shall occur. Risk is negative consequence that could occur, right? Right. Next. The internal auditor of Excel System Inc. observes that bank reconciliations have not been undertaken in the last quarter since the implementation of a new accounting software package. What type of risk has the internal auditor identified? What type of risk has he identified? Is it a financial risk, hazard risk, operational risk, strategic risk? Think, students. What is happening? Bank reconciliations. This process they are not doing. This is a process, a failure of process, people. Do you remember our systems? That is supposed to be operational. This is not a hazard risk. It's not a financial risk. It's not a strategic risk. This is an operational risk. Clear? Which of these statements is false? A. Treasury securities in the US would be given a weightage of 0% while computing capital adequacy ratio. Loans to individuals is given a weightage of 100% while computing capital adequacy ratio. C. Capital adequacy ratios are a measure of the amount of the bank's capital expressed as a percentage of its risk-weighted credit exposures. And D. Capital adequacy ratio is adopted by manufacturing companies over the world. So obviously this is false. Correct? It is thing by banking companies, not manufacturing, right? So, yeah. But students, when you are revising, when you are going through multiple choice questions here or elsewhere, and you have identified the false statement, also pay attention to the true statements. Remember, these are like revisions, right? So, treasury securities are given a weightage of 0%, individuals are given a weightage of 100% while computing the CAR, actually while computing the risk-weighted assets of the CAR, correct? Right. And capital adequacy ratio, measure of the bank's capital, percentage of the risk-weighted assets or the credit exposures. Correct? That is the meaning of the three statements. Next. The capital adequacy ratio used by banking companies is measured by which of the following ratios? Is it the sum of risk-weighted liabilities by Tier 1, Tier 2 assets, or risk-weighted assets divided by Tier 1, Tier 2 capital, or Tier 1, Tier 2 assets divided by risk-weighted liabilities, or the sum of Tier 1, Tier 2 capital divided by risk-weighted assets? That's too simple, right? Children, we've done it so many times. D is the correct answer, right? Tier 1 plus Tier 2 capital divided by risk-weighted assets. Which of the following is an example of political risk associated with foreign direct investment? A. Uncontrolled inflation. B. Nationalization of factories. C. Chance of a recession. And D. Exchange rate instability. What is uncontrolled inflation? It is economic risk, not political. Recession, economic risk. Exchange rate exchange rate fluctuations, instability, economic. So nationalization of factories, right? The government takes over the factories. That is a political risk. Match the following students with the corresponding types of risk. What you have, is it a hazard risk, strategic risk, financial risk, operational risk? Identify correctly. First one is a breakdown of the computer systems in the organization. Next, earthquake, warehouse is damaged. Supermarket has opened several physical stores. Now they are worried about the trend of online purchase of groceries. And 4, a single customer accounts for 40% of the revenue and now needs extended credit. Mark, I am proceeding with the answer. If you want time to think, do pause the video. Try to do it on your own. Breakdown of computer systems, operational risk. That's right. Earthquake, hazard risk. Correct. Supermarket, what is happening here? They opened stores. Now what are they worried about? Online purchase. What is that? Competition. Worried about competition. Strategic risk. There's a single customer. Single customer accounts for 40% of the revenue. He wants extended credit, right? That becomes a financial risk. Will he pay the money? We don't know, right? Risk management. Briefly, let's just understand what we are talking about. Risk management. What is risk? Risk is nothing but the identification. Then you assess the assessment, and how do you try to control, avoid the risk or minimize the risk or eliminate the risk, right? Of what? Of the risk to an organization's capital and earnings. The problem with risk is not very easy to identify or to quantify. What are the risks? How will you identify? To remember, think of such a large number of risks. So sometimes checklists, etc. are used. There may be different ways, but you have to identify, and quantifying also becomes a problem. A lot of it is our estimates. It's a bit subjective, but nevertheless, right? Organizational leaders have to try to identify the potential threats to the organization, right? Reduce its incidence, and they'll be prepared. Benefits. It aims to minimize losses and maximize the opportunities so that shareholder value is increased. Now you're anticipating dangers, so because of that, unpleasant surprises are kind of avoided because you're kind of prepared for them. Correct? They're either minimized, if not totally avoided. So disruption is minimized. The other thing is, because you are looking into the future, you are anticipating threats, you also get a chance to identify opportunities. When there is uncertainties, there could be both a threat and an opportunity, right? Now, a risk management, when there is risk management, right? And so many of these things are happening, right? You're taking care, you're prepared for unexpected events, etc. the cost of capital becomes less. What does that mean, students? It means, suppose I run an organization where there's a very efficient risk management process. When I want to borrow money from a bank, they are willing to give me the money and they will not charge a very high rate of interest because they feel their money will be safe with me. But let us say again I run another company where there is no risk management processes in place, none in place. The banks will not feel safe to lend money to that organization, and if they do lend, they will lend it at a higher rate of interest. So the cost of capital will go up if there is no proper risk management process. Follow? Overall, when there is risk management, there is a greater sense of assurance, right? You feel safer, the confidence of everybody, the employees, the managers, the regulatory bodies, government authorities, everybody feels more confident. There is a sense of assurance. Therefore, every organization should try and manage its risks. This would help an organization to reduce the probability of the negative events and reduce losses when negative events could not be prevented. So they'll try. So maybe reduce the number of times it will occur, and if they do occur, reduce the amount of losses. Now, of course, every organization is not the same. Different organizations, depending on their size, their complexity, the environment, and the industry to which they belong, may face different kinds of risk. So we can't just have one model to be applied to every organization. The risk management process consists of, like we said in the beginning itself, first we begin with the risk identification, then assess how much of the risk is there. Based on the assessment, you can rank the risks. Then you respond to the risk and you close with the monitoring of the risks. Dear students, this is how we proceed. Now let us go and look at each of these items one by one. Right?